ABC Limited has two classes of putable share, Class A and Class B share. On liquidation, Class B shareholders are entitled to a pro rata share of the entity's residual asset up to a maximum of rupees 10 million. Underline, up to a maximum of rupees 10 million. So can this be called as a deemed equity? Can this be called as a deemed equity? So you should say no, because there is a limit on the amount they will receive on pro rata basis. If it has to be a deemed equity, there should not be limit. There is no limit to the rights of Class A shareholders to share in the residual assets on liquidation, but this Class A has no limitation. Therefore, they will be treated as deemed equity, assuming other conditions are satisfied. So, examine the nature of the financial instrument. So, what you will say, the answer is there, question number 8. The cap of the rupees 10 lakh or 10 million means Class B shares do not have entitlement to a pro rata share of the residual asset of the entity on liquidation. Okay. So, therefore, Class B is not to be treated as deemed equity. Class B will not be treated as a deemed equity. So, this was just a theory question, not very important for exam. Just a minute. So come to the next concept called putable instrument in your book. Putable instrument, paragraph 18. What are putable instrument? Actually, this I had told you. Putable means the investor has the right to put back, the right to return the instrument to the equity against cash upon occurrence of certain condition or without occurrence of any condition. That means if you are the holder of the instrument, you can put it back and you can ask for the cash. Okay, you have the power to put it back and ask for the cash. Like example is units of mutual fund, shares in cooperative society. So there is a small summary chart we have prepared which will help you to identify whether a contract is a financial liability or equity. First point, paragraph below paragraph 18. If there is no contractual obligation, the standard is not applicable. If there is a contractual obligation to deliver cash or another financial asset, then it is a financial liability. Contractual obligation to deliver or plus exchange under potentially unfavorable condition, what will you call it? Financial liability. Element number 2, contractual obligation plus settlement in own equity instrument. Non-derivative contract, fixed test fails. Fixed test fails. We will call it financial liability, and fixed test passes. Fixed test passes. We will call it equity instrument. Contractual obligation plus settlement in own equity instrument. Derivative, fixed for fixed test passes. We will call it equity instrument. But fixed for fixed test fails. It can be variable for fixed, fixed for variable, variable for variable. We will call it financial liability. Point number 8, non-contractual obligation. No contractual obligation plus fixed test passes for non-derivative, then it is equity instrument. No contractual obligation plus fixed for fixed test passes for derivative, it is equity instrument. All conditions of paragraph 16A and 16B are met, it is deemed equity instrument. Any of the conditions of para 16A, 16B are not met, it is financial liability. All conditions of para 16C, 16D are met, deemed equity, and any condition of para 16C or 16D are not met, financial liability. Non-putable ordinary share. Non-putable ordinary share, always equity instrument. Preference share depends on whether It is a financial liability or equity will vary according to the terms and condition of the issue. For that preference share, we already had a chart in our book. Then warrants or written call option. Warrant or written call option will be treated as equity instrument. Is it right? So up to this we have discussed. Now the next point is treasury shares. One second, please. Come to treasury shares. What do you mean by treasury shares? Treasury shares means own share which have been bought back. They are called treasury share. If a company buy backs its own share, it is called treasury shares. In India, we call it buyback of share, but in foreign country they call it treasury shares. And in India, after buying back, you are required to cancel it because of the operation of the company law. But in other countries, it is not necessary that you have to cancel it. So what is the accounting entry for buying back your own share? So you will cancel the equity, but you do not recognize the profit or loss in P&L account. Rather, you will recognize the profit and loss in any component of equity. So the effect of buyback in our country is, you can write if you want, equity share capital account debit, and you will write to bank whatever payment you have made. Difference, if any, you can adjust in securities premium or any free reserve. That is how we do accounting in case of buyback of share. So that is why they are saying cancel equity. This is we are cancelling. Do not recognize any profit or loss on cancellation. We are not transferring the gain or loss to P&L account. The buyback consideration paid or received shall be recognized directly in equity. So all this presentation will be in SOCIE. Next point is, such treasury share may be acquired and held by the entity or by the members of the consolidated group. In India, you cannot buy and hold your own shares, but still the standard says you can hold it. If you are preparing the CFS, parent has issued equity share, subsidiary has investment in equity share of parent. What we are going to do, cancel this, minus that portion from the equity share capital of the parent. So cancel the number of share held by subsidiary in parent company. Is it right? In any case, if parent is holding in subsidiary, that gets cancelled in the consolidation procedure. So this is how you will do the adjustment in CFS. Till now, no question have been asked on this part, treasury share. But a potential question can arise from para 20. In para 20, they are asking you, which was one of the objective of the standard, can financial asset be set off against financial liability? Can financial asset be set off against financial liability? So your answer would be yes if following two conditions are satisfied. Condition number one is, there must be a legally enforceable right to set them off. There must be a legally enforceable right. So the law must permit you to do that. Law should not prevent you from doing that. So if this is company A Limited and it has a customer B Limited, B Limited also happens to be the creditor of A. From the same party, they are buying goods also, they are selling goods also. So B Limited is appearing as a debtor also, B is appearing as a creditor also. Can we set off them? First condition is the law must permit. The law must permit. So in India, the law does not stop you from doing that. But yes, if B Limited is a foreign entity, then FEMA will prevent you from doing that. What FEMA will say? Bring the amount separately, make the payment separately. Then there is no legally enforceable right. So you have to show it separately. Assuming first hurdle is passed, we have to also see that this party intends to settle on net basis. Party intends to settle on net basis. So I have to pay 1 lakh. I have to receive 80,000. So what is our understanding? That B will just pay 20,000 rupees to A. So if that is possible, you can present a net. If that is also not possible, they are intending to settle the asset and liabilities simultaneously. Simultaneously means A will pay to B 1 lakh and simultaneously B will pay to A 80,000. But if A has to pay to B, for example, after 3 years and B has to pay to A after 3 months, then you can't do set off because there is a difference in the timing of their receipt and payment. So if these two conditions are satisfied, welcome, you can set off the financial asset against financial liability. So when an entity has the right to receive or pay a single net amount and intends to do so, the logic is when you have to receive or pay a single amount and you are intending to do that also, so what the standard says logically, you are holding one single financial asset or one single financial liability. Okay, there is a question number 9. I have tried to put one question on every concept for revision purpose, theory backed by problems. Offsetting financial asset against financial liabilities. Entity A has a right to recover rupees 100 from entity B against sale and an obligation to pay rupees 100 to entity B against purchases. The amount is receivable and payable on demand. Can entity A set off the two amounts? So this question is nothing but you have to just answer by quoting the provision of the standard. There must be a legally enforceable right. Parties intends to settle on net basis or parties intends to receive the amount and pay the amount simultaneously. If those two conditions are satisfied, then entity A can set off the two amounts, because then in substance it represents a single financial asset or a single financial liability. So the answer is it depends on jurisdiction by jurisdiction basis, means it depends on the law, legal position. Secondly, one has to also verify if a legally enforceable right to set off exists. In addition, the criteria relating to intention also needs to be fulfilled before the amounts can be presented on a net basis. How will you recognize interest, dividend and gains and losses? So I will just give you a simple trick. If it is related to financial liability, it will be expense. It will be treated as expense in P&L account. But if it is related to equity, then it will be adjusted in SOCI. It will not be routed through P&L account. So if the payment is made on a financial liability like interest, it will be shown in P&L account as an expense. Okay. What about preference dividend? What about preference dividend? Will you show it in P&L account as an expense or will you show it as a deduction in SOCIE? The answer is whether the preference share is a financial liability or equity. Yesterday we have discussed that in some cases preference share can be a financial liability. So what will happen? The preference dividend paid on a preference share which is classified as a financial liability is also treated as expense for accounting purpose. For income tax purpose, matter is different. We are not talking about what Income Tax Act will do, but as an accountant, where will you transfer it? In the statement of profit and loss. But if the preference share is classified as equity, then you will deduct it from SOCIE. So that is how you have to do it. Financial liability, P&L account, equity item, SOCIE. Interest, dividend, gain on financial liability will be treated as expense. Then generally interest and dividend are called borrowing cost. Similarly, interest or dividend on financial assets are transferred to P&L account. What about the transaction cost on equity? This we had discussed some time earlier also. If you incur transaction cost on issue of equity instrument, then now it is not to be shown in P&L account, rather it will be adjusted against equity in the SOCIE. Underline. For example, share issue expenses will be directly adjusted in SOCIE. Transaction cost on equity, transaction cost on equity, again interesting point, which could not be issued. Which could not be issued. If you can't issue equity share, then the transaction cost will be transferred to P&L account. But if you have issued any equity instrument, the transaction cost will not be charged to P&L account. It will be shown in SOCIE as a deduction. Another thing you should know, equity instruments are never remeasured. Equity instruments are not remeasured. That means they will not be fair valued. And again, paragraph 22 is a small repetition only. Items which are treated as income or expense in the P&L account. For example, interest payment on a bond issued by the entity. Underline and remember, dividend payment on preference share, when classified as financial liability, is an expense. Gain and loss associated with redemption or refinancing an instrument is called financial liability. Any profit or loss on redemption or refinancing will be transferred to P&L account. And then we will see gain and loss relating to carrying amount of an instrument which is a financial liability. Dividends that are non-discretionary is a financial liability. Dividend which are non-discretionary means mandatory dividend. Management cannot avoid it. Financial liability, it will be shown in P&L account. Now the student has a query. If I am showing dividend as an expense, how do I present it? It is a financing cost. You can club it along with other interest liability, interest expense. Or if you want, you can present it as a separate line item. So dividend paid on preference share, which is treated as expense, can be added with the interest, or you can present it as a separate line item. Another issue is which items will be accounted directly within equity. Directly within equity means not through P&L account, but you will present it in the SOCIE, where you will put it in the respective column as a plus or minus. Like dividend payment on instrument which are classified as equity, you will not write in P&L account. I am talking about dividend payment. Dividend income will come in the P&L account. Dividend payment on equity instrument, you will show it as a deduction from retained earning in the SOCIE, correct? Then similarly, any cost incurred in issuing equity instrument, any cost incurred in issuing equity instrument will be deducted directly in the SOCIE. Example of such costs are mentioned here: transaction cost, regulatory fees, amount paid to regulatory agencies, legal, accounting, other professional advisor fees, stamp duty, etc. Same thing is mentioned in Ind AS 1 also, that if you incur any transaction cost relating to issue of equity instrument, it will be presented directly in equity. So this was little important part. Now the most important part from exam point of view is para 24. Very important for exam purpose, because I am going to now deal with compound financial instrument. Accounting treatment of financial liability under amortized cost method. So detail step by step I have written what you have to do, and then we'll take 2 or 3 examples, I think 3 examples, which will make the concept clear. Okay, and one of these questions will be asked in your exam also. So are you ready? When you are able to identify a financial instrument as a financial liability, first check, is it a pure financial liability or is it hybrid instrument? Pure financial liability means interest portion is also liability, principal portion is also liability. There is no equity attached to it. The entire instrument will be an obligation to pay in cash or other financial asset. But sometimes there can be hybrid instrument also. Hybrid instruments are called compound financial instrument because they have some component which are financial liability and some component which are equity. Because the accounting treatment of financial liability is altogether different from equity, substance over form, you need to split compound financial instrument into 2 parts, financial liability and equity. Then the financial liability part will be accounted as per the Ind AS 32 which we have learned, usually amortized cost. Some instruments will be FVTPL, some instruments are FVTPL. Which 4 instruments are FVTPL? Derivative, yes, 2. Second one, guarantee. Third one, contingent consideration. Fourth, to prevent accounting mismatch, management can designate an instrument as FVTPL. But other than that, it will be amortized cost method. And then equity instrument is not remeasured. Equity instruments are not remeasured. So if an instrument has an option to convert into shares, now today we'll solve problem of convertible instruments, where the holder or the entity has an option to convert into shares. That means it is not a pure financial liability. The option to convert into equity share is there. So that means there is some there is some equity component also in that. So this is an instrument. We have to divide into 2 parts, debt part, equity part. Debt part, financial liability will apply amortized cost method. Equity instrument is not remeasured, but then I need to find out how much is the equity component in that, right? So here we will go case 1. Look at the question. If principal amount is paid in cash on maturity, coupons are paid in cash periodically, this is a pure financial liability, already discussed. We have solved 1 or 2 questions also on that. If coupons are paid periodically and principal is redeemed by issue of underline fixed number of share. So fixed number of share means a fixed principal is exchanged for a fixed number of share. Fixed principal means I had to pay fixed cash. Instead of that, I paid a fixed number of share. Non-derivative contract. Definition, element number 3, which will be settled in own equity share. by issue of fixed number of share, they are called equity. That portion is called equity. Okay. But if coupons are paid periodically and there is an option to redeem in cash, the moment there is an option to redeem in cash, okay, or fixed number of share, both options are there. Option to redeem in cash also, and option to redeem in shares also. So therefore, this will also be treated as a compound financial instrument. This will also be treated as a compound financial instrument because there is an option to convert into a fixed number of shares. Pure financial liability we have already covered. And we'll see again, don't worry. But if it is a hybrid instrument, we need to split. Why we need to split? Substance over form. Financial liability is a different type of instrument for which different accounting is prescribed by the standard. Equity is a different type of instrument for which different accounting is prescribed by the standard. So you can't mix the two, which are subject to two different methods of accounting. So in the eyes of law, it is one instrument, but for the accountant, there are two instruments, and therefore we will split. So how do I split? I will identify the components of financial liability. That is, you have to check in the instrument, are there any contractual obligation to pay cash or other financial asset which cannot be avoided? Element number 1. Do you remember element number 1? Contractual obligation to pay cash or other financial asset and which cannot be avoided. Or check whether there is a contractual obligation to deliver variable number of own share. Element number 3, contractual obligation to deliver variable number of own share will make it a financial liability. Or there is a contractual obligation which cannot be avoided. This will form financial liability component. This will form financial liability component. That means those obligations which you can't avoid, those obligations which require payment in cash or financial asset, or those obligations which require settlement in variable number of own equity share. So those component of the instrument will be financial liability. Okay. Identify discount rate. Now how to split it? So for that they are saying, whatever are your contractual obligation, find out the present value it. Find out the fair value of it. Fair value means finding present value. To find the present value, what discount rate will you use? Market rate. In market, in similar instrument, how much rate of interest is charged? Is it right? With similar risk. All features are similar, but without all this conversion option and things like that. If I would have issued a plain vanilla instrument with no extra feature, how much interest would be charged today in the marketplace for a similar instrument but without all this conversion option, etc. So that rate of interest will become our discount rate. It will be either, it can be based on MIBOR or LIBOR also. Sir, what is MIBOR? Mumbai Interbank Offer Rate. What is LIBOR? London Interbank Offer Rate. So use this discount rate and use this contractual obligation to find out the present value of the liability. So discount step 1, step 2 by step 3. That is called financial liability. What about equity? Equity is the residual figure. Equity is the residual figure. As the definition of equity also says, equity is the residual figure. Equity, first you compute equity by calculating proceed without transaction cost. Proceed without transaction cost, and then deduct the financial liability as computed here in the step number 4. Balance is equity. If there is no transaction cost, your answer will stop here as far as splitting is concerned. But if there is a transaction cost, there is going to be a problem. And what is that? If there is transaction cost in issuing this instrument, the standard says the transaction cost is incurred on 2 instruments, not 1. So the transaction cost also needs to be divided between liability and equity. So transaction cost will be split in the ratio of financial liability and equity as computed in step number 4 and step number 5. I will go back. This is my step number 4 and this is my step number 5. So suppose this is 9 lakh, this is 1 lakh, and transaction cost is suppose 10,000 rupees. The cost of issuing this instrument is suppose 10,000 rupees. So I will allocate in the ratio of 9:1. So 90,000 will be 9,000 will be allocated to liability and 1,000 will be allocated to equity. Right? So the next task will be, if there is a transaction cost, split it in the ratio of financial liability and equity. So what will happen because of this allocation of transaction cost? One problem will arise. Your financial liability figure will change. Am I right? So financial liability was 9 lakh minus 9,000. So it will become 8,91,000. The moment the financial liability will change, the discount rate that you had used for present value calculation is no longer true, because I have to find a discount rate which will equate present value of future cash flow with the fair value in our books today. This 9 lakh was calculated using the market rate of discount, but the base number itself has changed. So what will happen to the discount rate? The discount rate will have to be recalculated. Oh my God. So if it is a compound financial instrument involving transaction cost, after allocating the transaction cost, you will have to compute the revised effective interest rate. Revised IRR you have to compute, and that revised IRR will be used for further accounting, not the original market rate. When will you use the original market rate? If there is no, if there is no transaction cost, or if there is no change in that financial liability figure that you have computed. But the moment that financial liability figure undergoes a change, you need to revise your IRR. Okay. And then your accounting would be like this. This is the main part. Amount received minus transaction cost, bank account debit, and as per your previous discussion, you will allocate this to financial liability as per step number 7 and to equity as per step number 6. So there is no gain or loss recognized here. Can you see initial entry, whatever net amount you will receive gets allocated between equity and liability, so no gain or loss is recognized. Then equity will not be subsequently remeasured. Equity will just remain in SOCIE. It will appear as a separate column in the SOCIE. It will not be remeasured. What about financial liability? As usual, we'll prepare an amortization schedule and calculate the effective interest on the opening balance every year using effective interest rate. Okay. And based on that amortization schedule, we'll do the accounting. If it is amortized cost instrument, as you have been already informed, change in fair value will not be adjusted. Change in fair value of a financial liability or even equity is not adjusted once recognized. Journal entry every year borrowing cost account debit, to bank account contractual cash flow, to financial liability balancing figure. If you want to pass one entry, if you want to pass two entry, break this entry into two parts, which normally I prefer, easy to present in the ledger also. First you pass an entry for interest liability accrued, borrowing cost account debit to financial liability, and then you pass entry for the payment of contractual cash flow, financial liability account debit to bank. Okay. What about the treatment of this borrowing cost? Borrowing cost will be charged to P&L account. However, if Ind AS 23 conditions are satisfied, it can be capitalized also. Ind AS 23 borrowing cost chapter is there. We will see, not yet seen. That standard says if borrowing cost is related to a qualifying asset, then you can capitalize it. Now comes the presentation part in the balance sheet. In balance sheet, the liability portion will be split into non-current liability, current liability. That portion which is due after 12 months, non-current liability, and that portion which is due within 12 months from the reporting date, they will be shown as current liability. So that also I am going to show you in one problem. Now comes the maturity date. So what can happen on maturity date? The instrument can get converted into shares. Okay, the instrument gets converted into shares. Suppose there is compulsory conversion, or the holder demands shares, So what we'll do? Now that equity account will be utilized to issue the shares. Equity account debit to share capital to securities premium. Okay. If variable number of shares have to be issued, variable number means it's a financial liability. Variable number means it is a financial liability. So you will pay out of financial liability. Financial liability account debit to share capital to securities premium. Suppose it is optional conversion. So financial liability will be paid by bank. Whatever financial liability exists, suppose the holder wants cash, pay him and say Tata. But then he says, no, I want share. If he wants share, what will you do? Balance in financial liability, I think what we will do, or this is also okay. First you transfer balance in financial liability to equity, and then equity account is used to issue share, and any balance is transferred to securities premium. Or this is also okay. You can issue shares, ultimately have to close it. Whatever balance remains in the equity will be transferred to other component of the equity. So entry financial liability account debit to share capital to securities premium. Any balance left in equity account will be transferred to securities premium or any other component of equity. Or what you can do, you can pass first this entry. Whatever balance is remaining, you transfer to equity, because the investor does not want cash, he wants equity shares. And then use the equity account to issue share capital, and surplus you transfer to securities premium. The effect is same whether you pass this entry or you pass this alternative set of entries. If you want to write, you can write. This is also okay. If the holder wants shares, now I don't have to pay the financial liability balance to him. Is it right? Then in that case, any balance in financial liability will be transferred to equity. and then equity account will be used to issue the shares. If he wants cash, our life is easy. Financial liability to bank will be closed and balance in equity will be transferred to any other component of equity. Balance in equity will be transferred to any other component of equity if the holder wants cash. So this is your compound financial instrument. Some notes are written for you for understanding. Ind AS does not tell you that you have to transfer the difference to securities premium, but that we do because of the requirement of the company's law. As per Ind AS, it can be transferred to any other component of equity. But then why do we transfer to securities premium? Companies Act. Any excess amount received over face value is credited to securities premium account. Does Ind AS uses the term securities premium account? No, that is a legal requirement. Ind AS says any other component of equity, right? Why do we separate it? This is the student's query, so I have made a list of notes. Normally what they ask, I have prepared a notes on that. First is, why do we need to separate? We need to separate because Ind AS focuses on substance rather than legal form. In legal form, it is one instrument. I have issued one instrument to you. You have paid 100 rupees to me. But in substance, I am charging you for two instruments. I am charging you for a financial liability instrument and charging you for equity instrument also. And the accounting of financial liability and equity are different. Hence, substance over form. Then the next issue will be, what about taxation? Income Tax Act does not recognize compound financial instrument. In income tax, the interest is based on actual coupon payment, which is allowed as a deduction, not as per effective interest rate. So there will be a deferred tax implication on that, because the balance in tax book will be different from balance in accounts book. So that we will discuss in Ind AS 12. So to help you with this, in Ind AS 12 there is a question on compound financial instrument. That time we will discuss. What about the interest? As I have told you, usually transfer to P&L account. Capitalization is possible under Ind AS 23. If you are following amortized cost method, you may be required to compute IRR. Either it is given or you may be required to compute it. Interest to be charged to P&L account is equal to opening balance of financial liability multiplied by EIR or IRR, not the coupon payment. No gain or loss arises from initial recognition of the component of the instrument separately. So initial recognition will have no gain or loss. Sir, why? Because I have allocated that amount over financial liability and balance amount I have allocated to equity. So where is the question of any balancing figure now? I have allocated the same amount over liability and equity. So no gain or loss arises on initial recognition. Now to make your concept clear, we will take a question which has transaction cost also, and we will also see the full presentation in the balance sheet and the profit and loss account also. So I will give you ledger, I will give you balance sheet, P&L account and the entire calculation part. So this is like a very comprehensive question on a compound financial instrument with all the necessary requirements. ASF Limited issued 8% debenture for rupees 10 lakh on 1st April 2020. 50% to be redeemed on 31st March 23 at a 5% premium. So this 50% will be redeemed. So it's a contractual obligation to pay cash, correct? So this portion I will treat it as a liability. and whatever coupon I have to pay, that also I will treat it as a liability. But what happens to the balance 50%? Balance 50% will be mandatorily convertible into equity share on 31st March 2024 next year. So next year you have to pay interest on the remaining 50%, don't forget, and it will be converted into fixed number of equity share. Although the question is silent on this, there is a mistake in the question, whether it is a fixed equity number or variable. So we will assume fixed. We'll assume fixed number of share will be issued. Transaction cost is 30,000. So this also I need to split between debt and equity. Assume market rate of interest without equity element is 10%. This will be first used for discounting purpose. First it will be used to find out what is the financial liability part. Later on, if the financial liability balance changes, which will change, you have to recalculate the IRR. Then this 10% is not applicable for further accounting. I have to recalculate the IRR. So you have to find out equity, liability, prepare ledger also, and also write down prepare financial statement extract. Prepare financial statement extract. Write in the question. This is a question designed for understanding purpose. Prepare financial statement extracts. Okay, so first what I'll do, first I will find out the financial liability component using market rate of interest. So what you will have to do very carefully, you will have to find out what is your contractual cash flow. Instrument was issued on 1st April 2020. First year end is 31st March 21. You will pay how much? 8% of 10 lakh. That is your interest, contractual obligation to pay interest of 80,000 to the holder. Present value factor at 10% would be 0.909 multiply 72,720. Then what is the next year ending date? 31st March 22. So same thing, only your factor will change. Second year factor 0.826 multiply 66,080. Third year there is an event. In the third year, 50% of the amount is redeemed by paying 5% premium. So 50% of 10 lakh, 5 lakh. In bracket, if you see, I have written 5 lakh plus 5%. 5 lakh 25,000 you have to pay, plus of course the interest of that year. So it will come to 6 lakh 5,000. The discount rate or factor is 0.751. Is the third year understandable? Yes. Fourth year, I will pay only interest on that 50% of 10 lakh, which is 8% of 5 lakh, because 50% has got redeemed here. What about the remaining 50% principal part? Remaining 50% principal part is not written here, because that is converted into a fixed number of equity share, which is mentioned in the agreement, that remaining 50% will be compulsorily converted into a fixed number of equity share. So that is not my contractual obligation to pay cash or contractual obligation to pay variable number of share. Is it right? So that portion is equity. That is not my contractual obligation to pay cash. That part will meet the fixed for fixed test. Against 5 lakh rupees, I am issuing a fixed number of share. So 5 lakh rupees meets fixed for fixed test. Hence, we will not consider that. But if it was an optionally convertible instrument, investor has an option to demand 5 lakh cash, which cannot be avoided, then I will take that 5 lakh also here. So now come to equity. First you compute equity but without considering transaction cost. What is my proceed? 10 lakh. What is my financial liability here? 620, 475. So therefore equity is 379, 525. Understood? But this is without considering the transaction cost. If transaction cost is not there, then your life is easy. You can save 2 steps further. But there is a transaction cost. So in this ratio, I am going to allocate that 30,000 rupees. So both liability and equity should take the weight of this transaction cost. So next working note will be allocation of transaction cost. What you will do, you can prepare a table like this for understanding. In this ratio, allocate the transaction cost. Take your calculator, try 620, 475 divide by 10 lakh multiplied by 30,000, 18614, and the other one you can keep it as a balancing figure without putting much effort. So what will be my adjusted financial liability now? Financial liability will be reduced by 18,614, equity will be reduced by 11,386. Understood? So my net figure would be financial liability 6,01,861. 368,139, total 9,70,000. Understood? So initial entry will be based on these figures. So see, the entry would be, what would be the entry? Guess. The entry will be bank account debit 9,70,000 to financial liability 6,01,861 and to equity 368,139. That entry I have printed in step number 5. Tick mark. But there is a small problem now. The fair value of liability, which was 620, 475, has changed. But the contractual cash flow has not changed. So I need to revise the EIR now. So see, how do you compute EIR? Make a list of the cash flows. Make a list of the cash flows. Then you assume a discount rate which will give you 0 NPV. So we have guessed 11% to start with. Why 11? Already market rate is 10% and you have reduced the value. Since you have reduced this fair value here, which means the discount rate has to be more. Higher the discount rate, lower the present value. Higher the discount rate, lower the present value. So it means your IRR will be little more than 10-11% because of that. So start with 11, find out the present value, the NPV, this is NPV 3861. It is positive, increase the rate. 12%, make it 12%. So now it is getting negative. One positive and one negative indicates your IRR is between the two rates, and then apply the interpolation formula. Lower rate plus NPV at lower rate plus NPV at lower rate, minus minus will become plus, and the difference between the two rates. I am sure you are aware of this formula. So this is now 11.26%. This is now 11.26%. So that means your ledger would be based on 11.26% and not 10%. So first entry on the date of issue of debenture or initial recognition on 1st April, bank account debit, I will write 9,70,000 directly. To 8% debenture, financial liability 6,01,861. To 8% debenture, equity 368,139. Is it right? If you want to prepare financial ledger, financial liability ledger, you can first prepare an amortization schedule. And what is that amortization schedule? It is nothing but it will tell you how much is your interest, how much is your closing balance. It is like a replica of your ledger only. So you can directly write in ledger also, not necessary, but it is better to prepare the amortization schedule. So start with which number now? This number, the revised financial liability number after deducting the transaction cost. Take 11.26%, 67770. Cash flow you will take from your step 1. If you go to step 1, you will find 80,000, 80,000, 6,05,000 and 40,000. Cash flow will come from step 1, 589, 631. Take 11.26% on that. 66392, 80,000. Then third year, take the 11.26%, 64680. What about cash flow? 860. Okay, make it 860. Some typing mistake. Okay, tell me cash flow. How much will you write in cash flow here? How much will you write in cash flow here? Not 80,000. 6,05,000. This is coming from step 1. And now the balance will be just 35,833. So last year what you do? I have told you a trick. Take the finance cost as a balancing figure. Take the finance cost as a balancing figure because I have to pay 40,000 rupees and after that my balance will become nil. How will your P&L account be affected? In your P&L account, these 4 finance cost will appear as a borrowing cost. Okay, these 4 will appear as a borrowing cost. So you will see in your book, step number 7, borrowing cost 2020-21, 67,770. Can you see this? What mistake the students make? They write 80,000, 80,000, 80,000, 40,000. That was your 11th, 12th standard accounting. Okay, those happy days are over. Now you will write effective interest that you are incurring, this column. And what about the balance sheet? I will explain here only. You look at your answer so that I won't have to change my screen every time. In your book, you see there is one SOCI also. Can you see that SOCI extract in year 1? SOCI extract in year 1. So in year 1, you will write opening balance 0 and add issue. In second column, there is a compound financial instrument written. What is that compound financial instrument? Equity portion, bracket equity portion. Compound financial instrument, here you write in bracket equity portion or just equity. So that equity portion goes in SOCIE, 3,68,139. That was in your first entry. And this 368,139 will remain here only till the end of the 4th year. And that time it will be used to issue the fixed number of equity shares. Is it right? So now balance sheet, check the balance sheet now. How the balance sheet would look like in year 1. So I need to first go to you that amortization table to explain this to you. Okay. This amortization table will help you to prepare the balance sheet part. How? What is the balance at the end of year 1? 589,631, last column. Students usually have a query how that bifurcation is done. This is my liability at the end of the year. But then out of this, how much is non-current liability and how much is current liability? How do I check that? So look at the next year. Look at the next year below. How much is the balance still there? 576,023. That means even after 1 year, this much balance is still there. So I will put 576,023 in the non-current liability part. Remaining amount, current liability. So what is remaining amount? Take on your calculator 589,631 minus 576,023. Is it 13608? 576,023 still outstanding at the end of year 2. So that liability is certainly payable after 12 months. Remaining, which has reduced, is the payable part in the 12 months. So that is current liability. Okay, I will ask you one more question. You go to second year. You find this is the liability. Out of that, 35,883 still there in the third year. So this 35,883 will become non-current liability. The next figure is non-current liability if it is lower than this figure. If it is higher than that figure, the entire amount is treated as non-current liability. So for example, just for understanding, if this figure is not 35,883, just for understanding, but instead of that it is 5,78,000, for example, possible, it all depends on numbers, then the whole amount will be treated as non-current liability. Then you don't write like this, non-current 578, current negative figure. How do you write current liability negative figure? So don't write it, just the entire amount you put it as non-current. Okay, so that is the point of preparing this table. It helps me to explain you the balance sheet presentation easily. So this is my SOCI first year balance sheet. Borrowing non-current liability portion will be 576,023 and balancing figure 13,608 is current. Similarly, in the second year, the non-current portion would be 35,833, which is still payable at the end of year 3. Balancing figure will be current liability. Does it make a difference? Yes, it affects your liquidity ratios. Do you remember liquidity ratio, current ratio, quick ratio, and it will affect your debt equity ratio also. If you put more in non-current, your debt equity ratio gets affected. If you put more in current liability, your current ratios and liquid ratios will get affected. Working capital amount will get affected. Many companies or many banks give you loan based on your ratios. How much working capital do you have? How much debt equity ratio do you have? So all these are important decision making aspects which will affect understanding of liquidity and financial performance and the financial risk involved. Okay, hence bifurcation is needed. Now you will prepare liability account. Very easy. So one more time we are practicing financial liability under amortized cost method. So start with the opening balance after transaction cost was deducted, 6,01,861, and then you provide finance cost. No need to calculate, you already have prepared an amortization schedule, right? Yes or no? Take the first year interest from there to bank. It is nothing but your that amortization schedule only. 2 lines will be the first and second column. Here 2 lines will be the last 2 columns. It's a replica, but in a ledger format. So you will be able to do it. Financial liability ledger is a replica of the amortization table. Same thing, but in a ledger format. In fact, if in the exam, if you don't have the time, the schedule is not required. Take opening balance, multiply by 12.26%, 11.26%, pay the amount, pay the balance. Bring the balance Again compute the finance cost. And after preparing the ledger, you can prepare the balance sheet extract. Okay. So this is your liability account. How the equity account would look like? Pay attention now. In your book, 8% debenture equity account is there. Opening balance by bank 368 139. But this account will not be remeasured. Because it is an equity account, no need to pass entry for interest using effective rate also. Just every year till the last year, buy balance brought down to balance carried down, buy balance brought down to balance carried down for 3 years. Now in the last year, as per the instruction given, remaining amount will be converted into equity shares. To equity account 368 139. This question has not mentioned how many equity share will be issued and what is the face value. So I have transferred the whole amount to equity. But if the number of shares to be issued are given, suppose 20,000 shares are to be issued and 10 rupees the face value. So you will write 2 lakh in the share capital account and any excess you will adjust in the securities premium. Or even if there is a deficiency, you adjust the deficiency also in the share premium or any other component of equity. I have written a note. Ind AS is silent as to which equity account will be debited or credited. We can use securities premium or general reserve or retained earning account. So that was a concept question. Now we'll take one exam question. November 2020 exam for 6 marks. Are you ready? Yes. Okay. On 1st April 2019, exam questions are easy. 8% convertible loan. So 8% is coupon rate with a nominal value of rupees 12 lakh was issued at par. So you realize 12 lakh rupees only. Proceed is 10 lakh. Proceed is 12 lakh. It is redeemable on 31st March 2023 also at par. What is the date of issue? 1st April 19. What is the maturity rate? 23. What is the life of this bond? 4 years. So 4 years we have to do calculation. So one option is, this is an option to convert into cash at par. The other option, alternative means option is given. It may be converted into equity share on the basis of 100 new share for each rupees 200 worth of loan. So there is a fixed number of share to be issued. 12 lakh rupees will be converted into how many shares? For every 200 rupees, 100 shares will be issued. For every 200 rupees, 100 shares will be issued. So for 12 lakh rupees, how many shares will be issued? 60,000. 60,000 or 6 lakh? Whatever. 6 lakh I think. 6 lakh share will be issued. That will not affect me much. I only wanted to check it is a fixed number of share will be issued. So therefore the instrument has some equity component also. So what are my contractual obligation in this problem? My contractual obligation is to pay 8% of 12 lakh for 4 years. If at the end of 4th year, if the holder wants cash, I have no alternative but to pay him the cash. So my obligation to pay cash cannot be unconditionally avoided. So will I consider that also in my calculation of contractual cash flow? Will I consider 12 lakh also in my calculation of contractual cash flow? Say yes. because that cannot be avoided. He has a choice. He has a choice. He can ask for cash. He has a choice. He can ask for share. But I as an entity will always keep myself ready. What if he asks cash? I have to pay him the cash. An equivalent loan without conversion option is 10% discount rate. So this 10% is discount rate. This company, interest of 96,000 has already been paid and included as a finance cost. Usual accountant's mistake in Ind AS, because we have been trained since decades to take the coupon rate and multiply by face value and treat it as an interest cost. That is what they have done, 8% of 12 lakh. So what entry the accountant has already passed? The accountant has passed the entry interest account debit to bank account 96,000. But is it right? It is not right. It is not based on effective rate. So we have to pass one rectification entry in this problem. This entry already passed. So I have to see what rectification entry needs to be passed. Okay. So what is the new thing about this question? You will have to pass a rectification entry for this transaction which they have already recorded. Understood? Now they have given you two discount rate as usual to confuse you. Which is required and which is not required. 10% is required. 8% is not required. I will use this as a discount rate. This is the market rate. Question is, how will the company present the above loan notes in the financial statement for the year ended 31st March 2020? So out of this entire thing, how much will appear as a liability, how much will appear as an equity, how much amount will appear in the profit and loss account only for 1 year, only for 31st March 2020. So you don't have to go till the end of 31st March 23. But of course 4-year data would be required to do the calculation. Good thing about this question, there is no transaction cost. So if there is no transaction cost, you don't have to revise that IRR figure, because I am not revising liability. So I won't be revising the IRR also. Ready? So first task is to compute the portion of financial liability here, that contractual cash flow which cannot be avoided. So I have to pay 96,000 rupees every year for 4 years, and in the last year, if the holder demands cash, I have a contractual obligation to pay that also. Factors are printed in the book, so take it from there only. Year 1920, 96,000, 96,000 again, 96,000 again. Use the factors, multiply, get the present value. Last year 12 lakh. Why we have added 12 lakh? That is a query from a student. Why we have added 12 lakh? It is a contractual obligation which cannot be avoided. Which cannot be avoided if demanded by the holder. It cannot be avoided. So that is the reason. Then student normally ask me, then in previous question, why you have not taken 5 lakh rupees? Because that was compulsorily convertible into a fixed number of share. So there the holder cannot demand 5 lakh. Here the holder can demand 12 lakh. So according to question, I have to keep changing the presentation. So my financial liability would be 1120, 320. 1120, 320. But you have raised 12 lakh rupees. Why will any knowledgeable person pay you 12 lakh when he can purchase other instrument from the market for 1120, 320? Because he is getting something more than this. is getting an option to convert into a fixed number of share. So that option to convert into a fixed number of equity share is also a consideration paid for acquiring this instrument, and for the company they have received that extra amount. In lieu of that, they will be paying a fixed number of shares. Is it right? And that is why this additional amount is treated like a equity. It is an option to buy shares. It is like, you can say, the holder has paid a premium to purchase a fixed number of share. Is it right? By paying that extra amount, he gets an option to buy a certain number of shares at a future date. And because that number of share is fixed, that portion is equity. If that number of share was not fixed, that portion will also become a liability, because I need to ensure that fixed amount against fixed cash, fixed number of share. So that condition is satisfied. Fixed for fixed test is satisfied here. Now compute the equity. Next, equity will be equal to balancing figure. Proceed minus liability 79680. Then we'll prepare this amortization schedule. Start with 1120,320. Take 10%. 1,12,032. Deduct the cash flow. Balancing figure. Next year 1136,352. Take 10%. Deduct 96,000. Balancing figure 1153,987. 1153,987. Finance cost 1,15,399. Paid 96,000. And this way, if the holder demands cash, your ledger will close at this point. So that's a cross check. Your calculations are moving in smooth direction. Now, the question has given a specific instruction that this company has already paid 96,000 and they have recorded it as a finance cost. But in the first year, if you look above, this highlighted one, this is what is the finance cost. 96,000 they have already treated as a finance cost. So what I'll do, I will pass the entry for the difference only. Otherwise, I will reverse the previous entry, then pass fresh set of entries, or you can just pass the entry for the difference. How much is the difference? 16,000 something. So that I will treat it as finance cost. So total finance cost debited would become now 1,12,032. And what about the credit? Not to bank. To bank was right. Credit will go to 8% convertible loan financial liability. So the liability part will increase. Normally what we do, normally we pass this entry, finance cost debit to finance liability, 1,12,032, 1,12,032. And what entry they have done? They have passed the entry finance cost debit to bank. This entry they have passed. Plus we pass one more entry, financial liability debit 96,000 to bank. These are the two right entries. And this is one wrong entry they have passed. So the differential is finance cost they have already debited 96, should have been debited 1120, so differential. Financial liability, if I would have passed the entry, I would have debited 96 and I would have credited this amount. So net effect in the financial liability would have gone is 16032 only. So this is the rectification of error. In 11th standard classes they teach rectification of error. This is also rectification of error. And then the question is how this will be presented in the financial statement in the first year. So in first year, my borrowing cost will appear 1,12,032, not 96,000. And in my SOCIE, that equity instrument component, equity component will appear under the head compound financial instrument 79680. This in bracket equity portion. And then balance sheet, equity and liability, equity, other equity, that same 79680, and non-current liability, financial liability, borrowing 8% convertible loan. Now look at that amortization table this time. Student, please, step 3, closing balance column, you will find 1136 352 and just below that 1153 987. Now when I look below, this figure is more than this. So this entire amount is non-current, because if your liability is more in the second year than in the first year, so nothing is paid out of the first year figure. So entire amount. Do not write here 1153 987. Okay, then you have to write minus figure here. You can't write minus figure in current liability. And what about current liability? Nil. So this is an exam question and this is the correct presentation. Okay. Any query on this question now? No. Why? Understood. One more question we will practice. Just presentation part. Why I am taking it, I will tell you. At the beginning of year 1, an entity issued 20,000 convertible debenture with face value rupees 100 at par. So 20,000 into 100, proceeds, amount raised 20 lakh. The debenture have a 6-year term. The interest at an annual rate of 9% is paid half yearly. The purpose of this question was, you may get a question in the exam which has half yearly coupon payment. So this is 9% is per annum. So for half year it is 4.5%. So your calculation of coupon payments will be not 9% of 20 lakh, 4.5% of 20 lakh, and here it is a 6-year term. It will become 12 half-year term. It will become 12 half-year term. So assume you are living in a world which has 1 year is equal to 6 months. So there are 12 years in this problem, not 6. Okay. The bondholder have an option to convert. Now one more complication. The bondholder has an option to convert half of the face value of debenture. Half means 10 lakh rupees. Total is 20 lakh. Half of it they can convert into 2 ordinary share at the end of year 3. For every 1 debenture, 2 share will be issued. Or, but this is an option. Or what he can do, those who are not exercising the conversion option will be repaid at par. Repaid at par means same face value 100 rupees to the extent of 50 per debenture. So they will get 50 rupees per debenture. So I will have to pay 20,000 into 50, 10 lakh rupees. Now understand, this is a compound instrument because there is a conversion of bond into fixed number of share involved. Fixed number of share. If they opt for share, 40,000 share will have to be issued. 20,000 into 2. If he doesn't opt for share, he can opt for 10 lakh rupees cash. But if he opts for 10 lakh rupees cash, can I avoid it? Can I avoid it? I cannot avoid it because it's an option. So will I consider 10 lakh rupees in my contractual cash flow calculation? Yes, because it cannot be avoided. And it is having an equity component in this instrument because there is an option to convert a fixed amount into fixed number of share. A fixed amount 10 lakh rupees can be converted into 40,000 fixed number of equity share. So there is a contractual obligation also, and there is a fixed condition also getting satisfied. So I will find out how much is the liability component, how much is the equity component. Wait, last paragraph has one more twist. The non-convertible portion will be repaid at 10% premium. Non-convertible portion means remaining 10 lakh rupees. But this 10 lakh will get 10% premium, 1 lakh more. So at the end of 6th year, we have to pay 11 lakh rupees in cash. This is also contractual cash flow obligation. At the end of 6th year. At the time of issue, the prevailing market interest rate is 10% market rate. Just you have to find out value of liability and equity. Write down value of liability and equity. Good question, because I have an experience with this problem. Many times the student make mistake in calculations. So we will practice it. If a problem where coupon is payable 6 monthly is asked, we can handle. So coupon rate will be divided by 2. Discount rate will also be divided by 2. Number of years will be multiplied by 2. In SFM, we tell you, if it is a semi-annual coupon paying bond, 3 changes are made in the calculation. Coupon rate divided by 2, discount rate divided by 2, number of years multiply by 2. I have seen students in the exam writing here 10%. Same question was asked in exam earlier. You will not get any mark for that. So that basic calculation has to be seen. So first 3 year, as per the question, the company will pay coupon first 3 year. So I have written 1-6. Why 1-6? Because semi-annual. So first 6 coupon will be paid on 20 lakh rupees. First 6 coupons will be paid on rupees 20 lakh at 9% into 6 by 12. 90,000. And how do you compute the discounting factor? 1-6, 5%. Anybody? Calculate 5.0757. Are you getting? Check. Is the calculation of factor right? Year 6, there is one more, or after 6th half year, there is one more transaction. The investor are given 2 choices. Either you get fixed number of share or you get 10 lakh. So if you take 10 lakh, you don't get shares. As a entity, I will hope that what if they ask for cash? Can I avoid it? No. Consider that. Take the 6th factor, 0.7462. Then again from 7 to 12 half year period, you will pay coupon. But on which amount? 10 lakh rupees. On 10 lakh rupees. Because 10 lakh rupees is deemed to have been redeemed. My liability will reduce by 10 lakh. Either he will opt for share or he will opt for cash. So my liability I will reduce by 10 lakh rupees. 45,000. Calculate the factor of 7-12. 3.7876. Yes, you're right. Multiply. And in the last year, 12th half year, redemption will take place at a premium of 10%. So 11 lakh. Take the 12th factor, 0.5568. So you will get 1985,935. This is my liability. So what is equity? Balancing figure. Equity is the balancing figure. This was a 4-mark question in the exam. But if you do it right, you'll get full 4 marks. So lot of mistakes student make. One is using a wrong discount rate here. Then some of them forget to multiply this by 6/12. Some of them don't consider this 10 lakh also because they think it is convertible into shares. It is not mandatorily convertible into share. It's an optionally convertible into share, so we'll consider that. Some of them forget to take premium here. And the big challenge is writing the discounting factor for 7-12, etc. So that is why I took the practice. Now we'll take a very important question from your study material. Write down this you revise before the exam, because nowadays questions from study material are simply copied and pasted in your exam. So what they can just simply put this in your exam. Are you ready? ABC company issued 10,000. Underline this word compulsory, mandatory, cumulative convertible preference share on 1st April 20x1 at rupees 150 each. So how much is the funds raised? 10,000 into 150. Proceed 15 lakh. The rate of dividend is 10% payable every year. So this is your contractual obligation to pay cash. The rate of dividend is 10% payable every year. So this is your contractual cash flow obligation. So this portion is financial liability. You have to discount it. The preference shares are compulsorily. Now here also it is written compulsory, and now they are saying compulsory convertible into 5,000 share at the end of the 5th year from the date of allotment. So since this is compulsorily convertible into equity share, I will not take 15 lakh in contractual cash flow. I will not take 15 lakh in the contractual cash flow obligation because it is going to compulsorily get converted into equity share. So I have an entity will not have to pay cash. Entity will have to pay a fixed number of share. So that 15 lakh I will treat it as equity, but we have to do the calculation. Okay, now they are saying when this instrument was issued, market rate was 15% on similar instrument. Transaction cost on the date of issue is 2% of the value of the proceed. Oh my God. So again the transaction cost problem will come. 2% of 15 lakh, 30,000. Then that will have to apportion between debt and equity. And again we have to recalculate the IRR. So now the details are summarized. Date of allotment, date of conversion. So 5 years is involved. Number of preference share, face value, total, rate of dividend, market rate on similar instrument, transaction cost, 30,000 is already given. Face value of equity share 10 rupees. And number of share to be issued are fixed. Can you see here? It is fixed number of share. So when it is fixed number of share, this is equity component. This is equity component. It is a non-derivative contract. Non-derivative contract. settled in fixed number of equity share. So element number 3, definition of financial liability, element number 3, if it is fixed, then it is not a liability, then it is equity. So what I'll do, first I will find out the liability component. I repeat, students have raised query on this on my email some days back only. Sir, why you have not taken 15 lakh? In the previous question you have taken 12 lakh. Please refund my fees. Your answers are inconsistent. Sorry, last line was not there. My dear student, it is written compulsorily convertible. In the previous question, optional was optional. So in optional, company may have to pay cash. So while accounting, the standard says if cash has to be paid which cannot be avoided, will be treated as a contractual cash flow obligation and will be considered in liability. Here I don't have to pay 15 lakh. It is compulsorily convertible. Understood? Why we have not taken 15 lakh? Rupees 15 lakh is not considered because it is compulsorily convertible instrument. So equity portion will be balancing figure, but first we will compute without the transaction cost. 15 lakh minus financial liability here equal to 997,177. 997,177. Is it right now? But because in this question we have transaction cost also, so I will have to first allocate the transaction cost in the ratio of the same amount, 5,02,823 and 997,177. Try. Take your calculator, 5,02,823 divide by 15 lakh into 30,000. 10056. So financial liability will reduce by 10056. It will be 492,767. Equity will also be revised by reducing it by 199,944. So 977,233. Got it? And then because your liability got revised, your EIR will get revised. So revised EIR. So my answer will be little more than 15% now. Already at 15% we had calculated that 5,02,000. But because the value has gone down, the rate will go up. Inverse relationship between discount rate and present value. So if present value has gone down, it means discount rate has gone up. Take 15 and 16% as your beginning rate and ending rate. Year 0, 492,767 I will take. Revised figure. Okay. 125 I will take coupon payment. 1,50,000 coupon payment. At 15%, 5,02,823. Check. I think it was already there in the previous table. Only at 16% you try. First get annuity factor on your calculator. First get annuity factor on your calculator and multiplied by 1,50,000. So are you getting 491,144? Find out the net present value NPV 10,056,1623. So IRR is 15.86%. IRR is 15.86%. Understood? Now we'll come to amortization table. because the question is to pass journal entries. My journal entry passing will become easier if I have the interest figure readily available. Yes or no? So I will prepare an amortization table, check the calculation. Opening balance of liability, I will start from 490 to 767. What is the mistake the students can make here? They will take 5,02,823. You have to take the figure after deducting the transaction cost. That is why we have taken the revised EIR. If you take 5,02,823 only, then what was the point in doing that EIR calculation? Start 15.86% of opening balance. 78153, cash flow 1,50,000, balance 420,920, and then you just check the whole table yourself. I will not read. Just tell me if you have any mistake in this table. There can be typing error, there can be calculation error. So I would just request you to have a quick look at it. This is a potential exam question for 8 marks. Trust me. Done. Everybody? And now we'll pass the journal entries. So what journal entry you have to pass on day 1? On day 1, when you issued the instrument, the net amount received was not 15 lakh, 15 lakh minus 30,000, 14 lakh 70,000, and you will apportion between preference share bracket liability, preference share liability 490 to 767, and to equity component of preference share 977,233. In bank account you write here 15 lakh, because last day when you revise, you should not have confusion how this 1470 has come. You are in the last day revision. This question is for last day revision, and then narration write yourself. At the end of there, what we'll do? At the end of the year, we are going to make a coupon payment of 1,50,000. Understood? So the entry will be preference share account debit to bank. This is annual coupon payment, and we are also going to recognize the finance cost. The entry for recognizing finance cost will be finance cost account debit to preference share. Wherever preference share is written, in bracket you write down liability component. First year understood? Then first year is over. There is no redemption here. Now this you repeat for 5 times. Oh my God, such a torture. So every year 2 entries you have to pass. Payment of dividend and finance cost. This finance cost figure you are getting from amortization schedule. Can you see that? Second year 66758. Third year dividend paid, finance cost 53556. Fourth year dividend payment entry and finance cost 38260. Fifth year dividend payment entry, finance cost as per question 20506. But in the last year, what you will do? You have to issue shares, not cash. So equity component of preference share, this figure will not change. Till 5 year it will remain same. 977,233. How many share will be issued in this problem? It is given. Check 5,000 share is given. 10 rupees face value is also given. This question has given you the details of face value and number. What about the surplus? That surplus 927,233 securities premium. Although Ind AS is silent, but in India the law says excess consideration received on issue of share is to be credited to account called securities premium account. Okay, now we'll come to another important concept called early redemption of financial liability. Early redemption, paragraph number 25. Theory paragraph number 25. Write down, very important. This also you need to have a look at this problem I am going to solve when you go to the exam, because in the exam situation on your own you will not be able to handle it. Okay, so this you have to practice in the last few days before the exam. There is a concept, and this concept is that what if an instrument is redeemed before maturity? Okay, what if the instrument is redeemed before maturity and it was a compound instrument? It was a compound instrument. If it is a pure financial liability, then there is no problem. Whatever amount you pay, financial liability to bank, whatever difference appears, P&L account. The problem will arise if a compound instrument is redeemed before maturity. Can the company do that? Yes, anything can be done as long as debenture holders agree or the terms of issue provide for it. Okay. So sometimes what happens, the market rate of interest may have declined. You had issued the bond, let's say you issued a 10-year bond. After 3 years, market rate of interest has declined substantially. You had issued the bond which carried 15% interest rate. Now the market rate is 9% or 8% for similar credit rating company. You are wondering why I should pay 15%. Let us talk to our debenture holder and tell them that, boss, I will redeem your debenture. Do you agree? He will say, why I will agree. Give them some extra amount. Give them something extra, na? Because to motivate him, to convince him to redeem early, because he must be enjoying 15% interest. Why he will redeem and take 9% from other new instrument now in the market? So some incentives are given like little more than the market values, etc. So the question is now how to close our two ledgers. Now it is two ledger involved. If it was only one ledger, financial liability, pay, close, difference, P&L account. But when you are early redeeming a compound instrument, you are early redeeming two instruments, not just the liability, you are early redeeming the equity. Early redemption of equity is also like buyback. Oh, and as you know, any gain or loss on the equity portion should not be transferred to P&L account, and that is where the complication lies. So the complication is whatever gain or loss will arise on early redemption, a part of it will go to P&L account which relates to liability, and a part of it should be adjusted in equity only. If I transfer the whole difference to P&L account, indirectly the gain or loss on the equity portion gets recognized in P&L account, which is wrong. Then you're violating the very fundamental principle of equity accounting. Gain or loss on equity is not transferred to P&L account. So the issue is gain or loss will be apportioned between liability, equity. Liability part goes to P&L account, equity part is adjusted in equity. So I will tell you how to bifurcate that gain or loss between the debt and equity. Okay. So keep reading here and keep looking at this diagram which I have designed for understanding purpose. Difference between carrying amount of financial liability and amount paid will be adjusted in P&L account and equity, and that is where the complication lies. So what you do, step number 1, go to your liability account and check what is the carrying amount. Check what is the carrying amount, book value. Can we do that? Yes. At any point of time, I can see what is the balance in my financial liability ledger. Then you see what would be the revised carrying amount based on balance cash flow and revised discount rate. Let us say out of 10 years, 3 years are over, 7 more years are remaining. So calculate the present value of the remaining 7 cash flow using the market discount rate now. Now means after 3 year. After 3 year. Because market rate has changed, which means the value of your liability must have also undergone a change. Am I right? If the market discount rate changes, the value of your liability also changes. When you had issued the bond, it was 15%. Now the market rate may be 12%. So calculate the fair value of the liability using remaining cash flow and the new discount rate. That means if the liability would have been issued today with the new rate, with the same cash flow, how much amount you would have realized for that? So this figure is suppose 5 lakh, but this figure comes to 5 lakh 20,000. Present value comes to 5 lakh 20,000, which means this 20,000 extra you are paying for settlement of the liability. This 20,000 extra you are paying for the settlement, because now the fair value of that liability is 520, but actually you have paid 5 lakh 50,000 to the debenture holder. Oh, so why did you pay that extra? That extra that you paid over and above 5 lakh 20,000 is for settlement of that equity component, because you are also telling him you lose your right of conversion also with that. So I am settling the equity part by paying 30,000 extra. Total amount paid extra 50,000. Out of that, the difference between carrying amount of debt and the present value of remaining cash flow discounted at market rate is the value of the liability. So that difference is only liability settlement. Anything paid extra over and above that is the consideration for equity settlement. So this gain is called gain or loss on remeasurement. I will just erase everything and tell you again. The difference between A and B will go to P&L account. This two will go to P&L account. This is simply you are settling your liability. The difference between these two, let us call it C. Difference between these two will be adjusted in equity. This is settlement of equity part based on balanced cash flow on the revised discount rate versus amount paid. It is called gain or loss on settlement of equity, and therefore it will be adjusted in equity. The equity component that is not eliminated will be reclassified to another line item within the equity. If any balance remains in equity, that will be transferred to other component of equity. That is how equity account is closed in this chapter. Understood? You want to draw this diagram or take a picture? On the right side, you can do it for next 5 seconds. Or if you have understood, then it is okay. Drawn? Wonderful. Students who are at home, they can also pause the video, write it, and now we'll see the application of theory. A very important question, and very important to understand it. Sometime from the institute's study material, because of the complicated presentation, the students are not able to understand. Sometimes some figure they put directly only, and then for your entire life you are wondering how this number had come. So I have tried to simplify it for you. Good question. On 1st April 2019, Shelter Limited issued 5,000 8% convertible debenture with a face value of rupees 100 each maturing on 31st March 2024. Okay. So when they issued the bond, interest rate was 8%. The debentures are convertible into equity share of Shelter Limited at a conversion price of 105. What does that mean? This is for calculating the number of share to be issued. This has no role in our answer. It will be used for calculating the number of share to be issued, which means suppose they have to pay 5 lakh rupees in this example. For calculating number of share to be issued, they will divide by 105. Because you have a query that what is the treatment of this 105? No treatment. Okay, this will be just required for calculating number of shares. Interest is payable annually in cash. At the date of issue, Shelter Limited could have issued non-convertible debt with 5-year term having a coupon rate of 12%. So this is your discount rate at the beginning when you will calculate the financial liability. So far the question is proceeding like the earlier problem, but on 1st April 2020, convertible debenture have a fair value of 5,25,000. So this figure they have given to you, which means now the same convertible instrument has a value of 5,25,000. Shelter Limited makes a tender offer to debenture holders to repurchase the debenture for rupees 5,25,000. So what this company said to the debenture holder, that we want to redeem your debenture for 5,25,000. And what was the total face value? 5 lakh. You are giving him 25,000 extra. You are giving him 25,000 extra. Is it right? Which the holder accepted. Okay, so he will accept. At the date of repurchase, Shelter Limited could have issued non-convertible debenture with remaining 2-year term. 3 years are over, 2 years remaining. So you could have issued fresh debenture for 9%. So that is my revised rate. So what I'll do, I will recalculate the value of the debenture using 9% discount rate and 2 coupon remaining, 2 cash flows remaining. Okay. Compare that with the book value after 3 years. That difference is gain or loss on settlement of liability part. And the difference between 5,25,000 and this amount which you will calculate is the gain or loss on settlement of equity part. Okay. So we'll read further. Show accounting entry in the books of Shelter Limited for recording of equity and liability component at the time of initial recognition and at the time of repurchase of convertible debenture. So you have to pass entry at this point, you have to pass entry at this point, and then to help you or confuse you, whatever you understand, 3 discount rates are given to you. 12% will be used for initial calculation of financial liability. 9% will be used on 1st April 22 for revised value of liability. 8% is to confuse you. Is it right? 8% will not be required in our answer. 10 mark question in the MTP of October 2020. So what we'll do? First, I'll go to the original question. Now, this question has a small area of doubt. What is the area of doubt? They have written in this line on the screen, the debentures are convertible into equity share From this line, it is not 100% clear whether it is optionally convertible or mandatorily convertible. Okay, so we will write an assumption in our answer before you start. It is assumed that debentures are optionally convertible. Otherwise, your answer will change. I am making same assumption which the institute had made. There is no other logic. Okay. It's not written anything now. It's not written compulsory convertible also. It is not written optionally convertible also. It is not written who has got the conversion option, whether the holder or the entity. To be on a safer side, follow the institute. Okay. Now we'll first compute financial liability. For 5 years, you have to pay 8% of 5,40,000. And in the 5th year, because the students used to raise query on this point, that why you have taken this. Previous problem you have not taken. It was mentioned previous problem compulsory convertible. Now there is no such words. So therefore we are making an assumption. 5 lakh. So originally this is how the company would calculate. Because on 1st April 19, they will not dream what will happen after 3 years. Is it right? 1st April 19, they will calculate based on facts on that day. So 427,691, equity balancing figure 672,309. Good news, no transaction cost. If no transaction cost, no need to recalculate the EIR. So what I'll do for a better understanding, even though they have not asked the ledger, but we will prepare the ledger. Ledger will help you to have an overall understanding of the situation. I need to reach end of year 3. Why I need to reach end of year 3? Because I need to find out what is my carrying amount on that day. This time I have not prepared amortization schedule. Did you notice? This means you can do directly also. Every time you have to just check opening balance multiplied by EIR. So first year EIR 427,691 into 12%. Pay the first cash flow of interest of 40,000. Balance brought down check 439,014. On that you compute 12%. To bank 40,000. To balance carried down 451,696. Check the calculation. Then you repeat it in the 3rd year also. Up to 3rd year there is no problem. When did the company offer for early redemption? 1st April 2022. So now you reach up to this date first. This is my carrying amount. This is my carrying amount. Now, how many more cash flows are pending? 2 more cash flows are pending. One is 40,000, one is 5 lakh. So 2 cash flows, one is 40,000, second year 40,000 plus 5 lakh. And what is the market rate of interest now? 9%. Anyway, before that, I'll complete the equity also for 3 years. Equity has no problem. Same amount by balance brought down, to balance carried down. So I will reach here also. So now we are on the date of early redemption. So what you should do, you will see there is a working note I have prepared below. Step 4 is written. So what you will do, you will find out that what is the liability, present value of the liability component today. So how many cash flows are remaining? We are standing here 1,422. One payment pending is on 31st March 23 and one payment is pending on 31st March 24. Here 40,000 is pending. 40,000 plus 5 lakh is pending. So this I will discount by 1 year, and this amount I will discount by 2-year factor. Ready? Factors are printed in the book. So 40,000 you are paying 2 times. So I have taken the annuity factor of year 1 and 2. Just add year 1 and 2 factor. Year 1 and 2 factor 9%. 9%. Is it 1.759? In your book, factors for 9% is given. And second year factor is 0.842. That is also given in the question. Now, can you give me the answer? Final figure. Final figure 491,360. This is what we call revised carrying amount of liability based on new rate. Based on new rate. So if I compare this figure with the book value, that difference is my loss on liability. That difference is my loss on liability. But I am actually paying him 5,25,000. Now you will understand. Now I am paying him 5,25,000. So difference between 5,25,000 and this amount is I am paying him to early settle or settle the conversion option only. Don't go for conversion. I pay you this much extra. Is it right? So that extra amount is to cancel the conversion option into equity share. So that is to be adjusted in equity. That is to be adjusted in equity. So the loss on remeasurement of liability, this figure will go to P&L account, and this figure will be adjusted in equity. So once again I will explain. The book value today is 465,900, and you are paying 5,25,000. So when I started the discussion, I said the gap is actually settlement of two things: settlement of liability, settlement of equity. So in the middle here, I calculated a number 491,360. This gap is settlement of liability, and this gap is settlement of equity. Understood? And accordingly you have to pass the entry. You have to pass the entry in such a manner that this 25,460 goes to P&L account, and this gets adjusted in the equity. Okay. So now I am going back to the ledger. Go to the debenture ledger, 4th year, credit side. By P&L account, I will transfer 25,460. By P&L account, I will transfer 25,460, and by loss on settlement 33,640. This I will adjust in equity. Don't forget equity in bracket, and to bank 5,25,000. So I am paying this amount. This goes to P&L account, and this is adjusted in equity. So P&L account will show this figure only. In SOCI, this figure will appear. And now I'll prepare the 8% debenture equity account. On the credit side, if you see, we have this number 72309. Contra effect of that entry here to loss on settlement 33,640, and remaining balance we will transfer to other component of equity. Remaining balance we will transfer to other component of equity. So the whole purpose of this calculation was to ensure that the gain or loss on cancellation of that equity portion does not get transferred to P&L account. So basically we were interested in finding this figure. What otherwise in your 11, 12 CPT foundation inter you do? You write 5,25,000 here. This is opening balance. The whole amount you transfer to P&L account. The whole amount is transferred to P&L account means you are transferring the loss on equity also to P&L account. Had it been a pure financial instrument, pure, no hybrid, then yes, transfer it to P&L account. So the standard setters are also thinking so deeply. For your benefit, you will read these notes later. Already I have explained line by line everything. Now we'll come to the last part of the standard, para 26 in the theory. Okay, I had promised you, I will tell you accounting mismatch. 4 types of financial liabilities are FVTPL. 4 types: derivative, guarantee, which I am going to teach in the next topic, contingent consideration, which we have discussed in 103, and accounting mismatch. So accounting mismatch means, suppose you have borrowed funds. Let us say the previous example only. You have issued 5% debenture. You have taken 10 lakh rupees by issuing debenture. So normally what you do, you will follow amortized cost accounting like we did in the last 4 or 5 questions today. No problem with that. But what did you do with this 10 lakh rupees? You invested in some financial asset. You invested in some, let us say, equity share. You invested in equity share. And this financial asset you are measuring at FVTPL. This financial asset, which the money was used to buy equity share, and it is a financial asset. So equity share are usually measured at FVTPL. Now see the problem. Whenever the price of equity share will fluctuate, your asset side will, what is happening? Fluctuate. But the liability side is constant there only, and this is only fluctuating. P&L account is also fluctuating. So why don't you also make this also FVTPL instrument? Both will fluctuate now. So when both will fluctuate, the loss in one will be compensated by the gain in other. So you have a minimum fluctuation. Okay. So you have minimum fluctuation. Otherwise, unnecessary, the same instrument is utilized here and you are making an impact on the P&L account. So why not change the accounting of this debenture also? So this debenture will also be measured at FVTPL. That can be done. That can be done if it helps you to save the accounting mismatch, prevent the accounting mismatch. This is called accounting mismatch. You had a heavy fluctuation in P&L account because the funds that you borrowed were accounted at amortized cost, but the funds where it was invested was accounted at FVTPL. Okay. So to avoid this mismatch, management is given a discretion. It can use FVTPL classification for a financial liability. And the last paragraph is first time application of split accounting. Split accounting means compound financial instrument. Under old GAAP, AS, which you study under, I think, intermediate accounting standard, there is no concept of compound financial instrument. There what we do, we pass entry bank account debit to debenture account, whether it is convertible or non-convertible. We don't differentiate. But the day you will apply Ind AS for the first time, that is called the date of transition. Now you can't do that. So you'll have to recalculate the value of the liability again. You have to recalculate the value of the liability. So calculate contractual cash flow balance like we did in the previous column. Compute the remaining cash flow. Whatever has gone has gone. You don't have to go retrospective. If the bond was issued in 1999 and your date of transition is 1/4/21, you don't have to go here and do the same calculation. If you make companies do such kind of activity, they'll be reluctant to adopt Ind AS. So make his life simple. How many cash flows are remaining? You will say 4 cash flows are remaining. What is the discount rate here? 8%. So why can't you do this calculation? That is easy. That is easy. So use that discount rate and you record it as a financial liability on the date of transition. Remaining cash flow discounted at the rate on the date of transition will be recorded as a financial liability. The earlier liability which is recorded will be cancelled. Earlier liability, any amount appearing will be cancelled. Difference will be adjusted in retained earning. So your book value may be 1 lakh rupees here, whereas this calculation may give you 90,000 rupees only. So 90,000 liability you will record, 1 lakh you will cancel. So old liability debit to new liability, and the difference will be to retained earning. On the date of transition, we don't hit P&L account. On the date of transition, adjustments are made in directly retained earning or other equity component. So this wonderful chapter in Ind AS 32 is over. Now we'll take a break.